What if one of America's strongest retailers is finally starting to show the pressure that consumers have been feeling for years? Because Walmart has always been one of the companies I would watch when trying to understand the American consumer. Not because Walmart is a perfect representation of the entire economy, but because of the sheer number of people it serves and the type of products it sells. People can postpone buying a new television, they can delay buying furniture, they can skip a vacation, but they still need food, household products, medicine, clothing, and other everyday necessities. And that is exactly why Walmart matters. Welcome to Macro Bullion. I'm Alex James, an independent economic analyst, and today we're going beyond the headline numbers to examine what Walmart's latest results could be telling us about the American consumer, inflation, interest rates, and ultimately the environment for gold and silver. Now, I want to start with an important distinction. A weak Walmart quarter does not automatically mean the U.S. economy is entering a recession. One company's results cannot prove that, but Walmart can provide a useful signal, and the signal described in this report is concerning. Walmart's U.S. comparable sales increased only 2.6% during the quarter ended July 31st, according to the source material, well below the 3.8% analysts were expecting. The source characterizes this as the company's weakest U.S. comparable sales growth since 2020. That is particularly interesting because Walmart has historically been positioned as one of the retailers consumers turn toward when their budgets are under pressure. When inflation squeezes household finances, consumers often look for cheaper alternatives. They trade down from premium brands. They search for discounts. They buy more private label products, and they become more selective about discretionary spending. Walmart should theoretically benefit from that behavior. But what happens when even Walmart begins to see consumers pulling back? That is the question investors need to ask. The report says Walmart's physical store comparable sales declined in the low single digits, while e-commerce sales increased 24%. That tells us something important about consumer behavior. People haven't necessarily stopped spending. They may simply be changing the way they spend. They may be shopping online more. They may be purchasing groceries and other necessities while avoiding additional purchases. And that distinction is critical because Walmart's business model depends on getting customers into the store for necessities and then selling them higher margin discretionary products while they are there. If the customer walks in for groceries, buys exactly what they need, and leaves, Walmart can still generate revenue. But the profitability of that customer can be very different. And this is where the story gets much more interesting. The source also points to a broader shift toward cheaper products and store brands, similar to what has been seen with consumer goods companies such as Procter and Gamble. That would suggest consumers are becoming increasingly price sensitive. And price sensitivity is something I want to watch very closely because it can reveal economic stress before a recession officially appears in the data. Think about your own household budget. If groceries, gasoline, housing, insurance, and borrowing costs all become more expensive, you don't necessarily stop spending. You start making different decisions. Maybe you buy the store brand instead of the name brand. Maybe you delay buying something you don't urgently need. Maybe you shop online to compare prices. Maybe you buy the cheaper version, and that is why headline retail sales can sometimes be misleading. A dollar spent today is not necessarily equivalent to a dollar spent several years ago. If prices have risen substantially, consumers can spend more money while actually purchasing less. That is the distinction between nominal spending and real purchasing power. And for investors in gold and silver, this distinction matters enormously. Because if consumers are being squeezed by inflation while the government is simultaneously dealing with enormous debt and elevated borrowing costs, the macroeconomic pressure does not disappear. It simply moves from one part of the economy to another. The consumer feels it through prices, businesses feel it through wages, financing costs, and demand. The government feels it through interest expenses, and investors feel it through markets. So Walmart's numbers alone do not prove that a recession is here, but they may be telling us something about how consumers are adapting to a much more expensive economic environment. And if this pressure spreads beyond Walmart, if more retailers begin reporting weaker discretionary demand, declining traffic, lower margins, and greater dependence on promotions, then the warning becomes much harder to ignore. Because Walmart is not normally the place where consumers go when they want to spend extravagantly. It is one of the places they go when they want value. And if even value-conscious consumers are becoming more selective, we need to pay attention. The bigger question now is, what is causing that behavior? Is it simply changing shopping habits? Is it inflation? Is it high gasoline prices? Is it higher borrowing costs? Or are all of these pressures beginning to hit American households at the same time? That is where the story moves from one retailer to the entire macroeconomy. We're going to connect Walmart's consumer warning to inflation, energy costs, treasury yields, and the growing cost of borrowing, because that is where the pressure really starts to compound. Now let's connect Walmart's results to the bigger economic picture, because a consumer does not make spending decisions in isolation. When households start becoming more selective, there is usually a reason behind it. And right now, Americans are dealing with several pressures at the same time. Food costs matter, energy costs matter, housing costs matter, insurance matters, and borrowing costs matter. The problem is that these expenses compete for the same household income. If more of your paycheck is going toward necessities, there is less available for everything else. That is why Walmart's results are interesting. Walmart's U.S. comparable sales grew 2.6% in the latest quarter, according to the company's SEC filing. That was positive growth, but it was also much slower than the market had expected. And there is an important detail here. Positive sales growth does not necessarily mean consumers are becoming financially healthier. A household can spend more dollars while purchasing fewer goods if prices have risen. That's the difference between nominal spending and real purchasing power. Imagine that you spent $100 last year on a basket of everyday products. If the same basket costs $104 this year, you can technically say spending increased 4%. But you didn't necessarily become a stronger consumer. You simply paid more for roughly the same things. This is why I think investors need to be careful when they look at retail numbers without considering inflation. The question isn't only how many dollars did consumers spend? The better question is, what did those dollars actually buy? And this brings us directly to energy. Gasoline is one of those expenses that households cannot easily eliminate. You can postpone a new television. You can delay buying new furniture. You can decide not to eat at a restaurant. But if you need to drive to work, take your children somewhere, or run basic errands, gasoline is difficult to avoid. When energy prices rise, the pressure doesn't stop at the gas station either. Higher transportation costs can eventually affect the cost of moving products, operating businesses, and delivering goods. That can feed into prices elsewhere. So an energy shock can squeeze households from both directions. You pay more directly for fuel while potentially paying more indirectly for products and services. And that is particularly important when consumers are already becoming more price sensitive. Now take that pressure and add interest rates. The U.S. Treasury recently increased the size of certain long-duration bond buyback operations from $2 billion to at least $4 billion per operation. The move came after long-term Treasury yields had climbed sharply, with the 30-year yield reaching around 5.34%, its highest level since 2007, according to Reuters. The Treasury intervention helped push yields lower initially, but the larger point is that it does not eliminate the underlying forces determining long-term interest rates. Investors still have to decide what return they require to hold long-term U.S. government debt. And if investors demand higher yields, that affects the entire economy. Mortgage rates can rise, corporate borrowing becomes more expensive, car financing becomes more expensive, and companies that depend heavily on borrowed money have to spend more simply to maintain their existing operations. This is where the consumer story and the bond market story start connecting. If households are already becoming more selective and businesses are simultaneously facing higher financing costs, the economy can lose momentum from both sides. And there is another layer to this. The U.S. national debt has now crossed the $40 trillion threshold, according to recent reporting. That does not mean a financial crisis is guaranteed. It does mean the government's interest burden becomes increasingly important as debt grows and refinancing continues. This is why the Treasury market deserves so much attention. The government can influence market conditions through its operations, including buybacks, but it cannot simply dictate the long-term price of money forever. Ultimately, investors still determine the yield they are willing to accept. And that creates a potential feedback loop. Higher debt can mean greater financing needs. Greater financing needs can increase sensitivity to interest rates. Higher yields can increase borrowing costs. Higher borrowing costs can pressure households and businesses, and weaker economic conditions can then affect corporate earnings and consumer spending. That is the macroeconomic chain we need to watch. Now, none of this proves that the United States is already in a recession. That's an important distinction. A weak Walmart quarter does not prove a recession. A $40 trillion national debt does not prove a recession. High Treasury yields do not prove a recession. These are signals and pressures that need to be analyzed together. And there is one more reason Walmart's report deserves attention. The company's global e-commerce business continued to grow strongly, showing that consumers are still spending. The problem is that the pattern of spending appears to be changing rather than simply disappearing. That may actually be the more important warning, because economic weakness doesn't always begin with people completely stopping their spending. It can begin with people changing what they buy. They choose cheaper products, they reduce discretionary purchases, they search for promotions, they move toward private brands, and they become much more careful about every dollar. That behavior can eventually show up in corporate margins. And that is exactly where I want to take this story next. Because if consumers are becoming more selective while businesses face higher financing costs, the next question is whether corporate profits can continue to hold up. And if corporate profits start weakening at the same time that bankruptcies and credit stress are increasing, then we may be looking at something much larger than a Walmart earnings disappointment. We may be looking at an economy where the surface level numbers still look stable, while the pressure underneath is becoming harder to ignore. Now we move from the consumer to the companies that depend on that consumer, because this is where an economic slowdown can become much more serious. When households become more selective, businesses have to respond. They cut prices, they increase promotions, they push private label products, they invest more heavily in online sales, and sometimes they accept lower margins simply to keep customers coming through the door. Walmart's latest results actually give us a good example of this transition. The company reported U.S. comparable sales growth of 2.6%, while e-commerce sales increased 24%. Walmart also said its U.S. business benefited from broad-based share gains, including among higher-income households. So this isn't a story about consumers completely disappearing. It is a story about consumers becoming more selective. And that distinction becomes extremely important when we look at the broader economy, because businesses can survive weak demand for a while. What becomes dangerous is when weak demand combines with expensive financing, rising defaults, and declining confidence. That is where credit markets start becoming important. According to the U.S. courts, total bankruptcy filings reached 608,511 in the 12 months ending June 30th, 2026, up 12.2% from the previous year. Business bankruptcy filings increased 16.9% over the same period. Now let's be precise. That does not mean the United States is already in a financial crisis, and the current level remains well below the enormous bankruptcy totals seen after the global financial crisis. But the direction is worth watching. Filings have been rising from their post-pandemic lows. For businesses, higher interest rates can make refinancing more expensive. For households, higher rates can make mortgages, auto loans, and other forms of credit more expensive. And when debt becomes more expensive at the same time that consumers become more cautious, weaker companies can find themselves under increasing pressure. This is why the private sector credit market matters. Financial crisis economist Tuomas Malinen has recently pointed to corporate bankruptcies and private sector yields as two warning signals. His argument is that if corporate borrowing costs continue rising relative to benchmark rates, financial stress could become more significant. But I want to make another distinction here. That is his warning, not an established forecast. There are plenty of economists who disagree with a near-term recession call, and some mainstream indicators still show economic growth. So we shouldn't tell viewers that a recession is guaranteed. The responsible question is whether the warning indicators are becoming strong enough to deserve attention. And I think they are. Now consider the structure of the American economy. You can have a stock market reaching impressive levels while many households are struggling with higher living costs. You can have strong corporate investment in artificial intelligence while traditional businesses face weaker demand. You can have rising GDP while consumers feel that their personal financial situation is deteriorating. That is what people increasingly describe as a K-shaped economy. One side continues moving higher, the other side struggles to keep up. And Walmart itself provides an interesting example of this. The company said it continued gaining share among higher-income households. At the same time, rising fuel costs were identified as a pressure on consumers, and Walmart was investing in lower prices. That tells us the economy isn't behaving as one single block. Different households are experiencing completely different financial realities. A household with significant investment income, home equity, and strong wages can continue spending. A household dealing with rent, food, gasoline, insurance, and credit card payments has a very different calculation. And that creates an unusual situation. The top portion of the consumer base can keep supporting spending even while lower income households pull back. That can make headline economic numbers look healthier than the experience of a large portion of the population. But there is a risk. If the stronger consumer eventually starts slowing down too, there may be less of the economy left to absorb the weakness. And this is where the artificial intelligence boom enters the story. The current investment cycle is heavily concentrated in technology, data centers, and AI infrastructure. As long as companies continue spending enormous amounts of money in those areas, that investment can support economic activity. But it also creates sensitivity to financing costs and investor expectations. If long-term treasury yields rise, corporate borrowing becomes more expensive. If investors begin demanding higher returns from technology companies, valuations can come under pressure, and if companies reduce capital spending, the economic effect can spread through construction, equipment, energy, transportation, and other industries connected to that investment. Again, I'm not saying an AI collapse is inevitable. I'm saying the concentration of economic strength in a relatively narrow group of sectors creates a vulnerability worth monitoring. This is why I don't want to look at Walmart in isolation. Walmart tells us something about the consumer. Bankruptcy data tells us something about financial stress. Corporate bond yields tell us something about the cost of capital. Treasury yields tell us something about government financing conditions. And the stock market tells us what investors currently expect. When all of those signals point in the same direction, the warning becomes much stronger. Right now, they are not perfectly aligned. And that is important. There are still areas of strength. Walmart's e-commerce business is growing rapidly. The company has raised its full-year sales outlook. Higher-income households continue to support spending, and the broader economy has not simply stopped growing. So the honest conclusion is not that everything is collapsing. The more interesting conclusion is that the economy appears increasingly divided. Some parts are expanding aggressively, other parts are showing stress. And the question is whether the strong parts can continue carrying the weak parts, because if they can, the economy may continue expanding despite the pressure. But if consumer spending weakens further, corporate bankruptcies continue rising, credit conditions tighten, and investment in the strongest sectors slows, then the downside risk becomes much more serious. And that brings us to the final piece of this puzzle. What does all of this mean for gold and silver? Because if the economy is facing a combination of fiscal pressure, elevated borrowing costs, consumer stress, and uncertainty over the dollar, precious metals become much more than a simple inflation trade. They become part of the broader debate about confidence in the financial system. We're going to connect that directly to gold, silver, the dollar, treasury yields, and the potential scenarios investors should be watching next. Now we can finally connect the consumer story to the part of the market that matters most to us here at Macro Bullion, gold and silver. Because if Walmart is showing signs that consumers are becoming more selective, while treasury yields remain elevated and concerns about government borrowing continue, the question becomes very simple. Where does capital go when confidence in the economic outlook becomes less certain? And this is where precious metals enter the conversation. Gold has already been sending a very interesting signal. After the Treasury announced larger buybacks of longer-dated government debt, gold moved above $4,600 as the dollar weakened and investors reassessed the outlook for U.S. fiscal policy. Silver also moved sharply higher, approaching the $70 area. Now, I want to make something very clear. That does not prove that Treasury buybacks are automatically bullish for gold. It also does not prove that the dollar is about to collapse. Those are much bigger claims than the evidence allows us to make. What we can say is that the market reacted in a way that is consistent with growing attention to fiscal risk, long-term yields, and the value of the dollar. And that is important because gold does not need a recession to perform well. Gold can benefit from several different environments. It can attract demand when inflation is persistent. It can benefit when real yields decline. It can attract safe haven demand when geopolitical uncertainty rises. And it can also benefit when investors become concerned about fiscal sustainability or currency risk. That makes gold very different from a traditional risk asset. Gold is no longer simply a commodity, it becomes a store of value argument. And that is why the next phase of this story is going to be so important. The question isn't whether Walmart alone can predict a recession. It can't. The question is whether Walmart's consumer warning, elevated treasury yields, rising government debt concerns, and strength in precious metals are separate stories or different pieces of the same macroeconomic puzzle. And if they are pieces of the same puzzle, then the implications extend far beyond one retailer. They reach directly into the future purchasing power of the dollar, the cost of borrowing, the health of the consumer, and the role gold and silver could play in a more uncertain financial environment. That is what we'll bring together. So after putting all of these pieces together, what are we actually looking at? I don't think the honest conclusion is that Walmart is collapsing, that a recession is guaranteed, or that gold can only go higher from here. The evidence is more complicated than that. Walmart is still a massive and financially powerful company. Its total revenue increased, its operating income increased, e-commerce continued to grow rapidly, and the company actually raised its full-year sales outlook. Walmart's own results show that U.S. comparable sales increased 2.6%, while e-commerce sales increased 24%. The company also said that comparable sales, excluding the health and wellness impact, were stronger at about 3.4%. So we should not turn one disappointing number into a story that everything is falling apart. But the warning is still important. The reason investors reacted so aggressively is that Walmart is normally one of the retailers that benefits when consumers become more price conscious. And yet its U.S. sales growth slowed to the weakest pace in 6 years. Reuters reported that Walmart shares fell about 9% after the results, while higher fuel prices and concerns about consumer spending added to the pressure across the broader market. That is the signal I want to focus on. Consumers are still spending, but they are becoming more selective about where that money goes. Transactions increased 1.5%, while average ticket growth was only 1.1%. That means the customer is still showing up, but the amount being spent per transaction is growing much more slowly. And that tells us something important. Economic weakness doesn't necessarily begin with empty stores. It can begin with smaller baskets, cheaper brands, fewer discretionary purchases, more price comparisons, more online shopping, and greater sensitivity to gasoline and food prices. That is exactly why Walmart is worth watching. Now take that consumer pressure and place it next to the bond market. Treasury's expanded buyback program initially helped push long-term yields lower, but the relief was temporary. By Thursday, the 10-year Treasury yield had moved back toward 4.7%, while the 30-year yield remained above 5.2%. That tells us something. Government intervention can influence market conditions, but it cannot simply dictate where long-term borrowing costs remain forever. Investors still determine the yields they require to hold long-duration government debt. And if those yields remain elevated, the consequences spread throughout the economy. Mortgages become more expensive, corporate financing becomes more expensive, capital-intensive industries face higher costs, and highly valued companies that depend on future growth can become more sensitive to interest rates. That brings us back to the bigger macro question. Can the American economy continue growing while consumers become more cautious? Government borrowing remains enormous and long-term financing costs remain elevated? Maybe. There are still important areas of strength. Walmart's e-commerce business is expanding rapidly. Higher income households are still spending. Businesses continue investing in technology and infrastructure. And the economy has not suddenly stopped functioning, but the margin for error may be getting smaller. If consumers continue trading down, if fuel costs remain elevated, if corporate bankruptcies continue rising, and if credit conditions tighten further, then the economic slowdown could become much more significant. And if that happens while investors are simultaneously questioning the sustainability of government borrowing, the environment for gold becomes increasingly interesting. Gold doesn't need a recession to rise. It can respond to inflation concerns, falling real yields, geopolitical uncertainty, dollar weakness, and concerns about fiscal policy, but it can also fall. If the dollar strengthens sharply, real yields rise, inflation remains stubborn, and investors become more confident in traditional assets, gold can experience significant corrections. Silver carries even more uncertainty because of its industrial exposure. If global economic activity remains strong, industrial demand can help silver. But if growth deteriorates sharply, silver can be more volatile than gold. So I don't want to give you a simplistic message. I don't want to say Walmart equals recession. I don't want to say treasury buybacks equal money printing. And I don't want to say debt automatically means gold goes straight up. Those statements go beyond what the evidence can prove. What we can say is that several important signals deserve attention at the same time. Walmart is showing slower U.S. comparable sales growth. Consumers are becoming more price sensitive. Fuel costs are putting additional pressure on household budgets. Long-term treasury yields remain elevated. The government has increased its treasury buyback operations, and gold and silver remain near historically significant levels. Those are facts and observable market developments. The interpretation comes next. My interpretation is that the U.S. economy is becoming increasingly divided between areas that remain strong and areas where financial pressure is becoming more visible. And that is why I will be watching the consumer just as closely as I watch the treasury market. Because if the American consumer finally cracks, the consequences could reach corporate earnings, employment, credit markets, and ultimately financial markets. But if consumers stabilize, inflation cools, and long-term yields decline, then the economy could avoid the more severe scenario. That is the uncertainty. And nobody has a crystal ball. So here's what I would watch from here. Watch Walmart's next sales report. Watch real consumer spending rather than only nominal dollar growth. Watch gasoline prices. Watch the 10-year and 30-year treasury yields. Watch the dollar. Watch corporate bankruptcies and credit spreads. And watch whether gold can hold its recent breakout while silver continues to attract demand. If those signals begin confirming one another, the macro story becomes much more powerful. If they start moving in opposite directions, we may simply be looking at another period of volatility rather than the beginning of a major economic downturn. And that is ultimately the lesson from Walmart. The headline isn't that America has stopped spending. The headline is that Americans may be changing how they spend. And sometimes that change in behavior is more important than the headline sales number itself. For macro bullion, that's the bigger story, because markets don't wait for the official recession announcement. They begin repricing risk long before the headline arrives. So keep watching the data, keep questioning the narrative, and most importantly, don't confuse a strong headline with certainty. This is not financial advice. I am not a financial advisor. This analysis is for informational and educational purposes only. Always do your own research, verify the underlying data, understand the risks, and make decisions based on your own circumstances. If you found this analysis useful, subscribe to Macro Bullion and let me know in the comments. Do you think Walmart is simply experiencing a temporary slowdown, or is it giving us an early warning about the American consumer? And what matters more for gold from here, the consumer, treasury yields, the dollar, or inflation? I'll be watching the data, and we'll follow the evidence. See you in the next analysis.